consolidation being the trend, but it's why, right? Why is the consolidation and will the consolidation continue? Everyone asks me all the time, where are we in this process? And I still think we're in other firms are having a difficult time competing, right? And so, the old expression, if you can't beat them, join them. So if we look at what's underneath these firms, it's an older advisor base. The larger firms are bringing in younger advisors at a faster rate than some of these legacy smaller, boutiquier firms.
Yeah, I mean, I speak with a lot of financial advisors, obviously, that are considering making a move to another firm, and one of their biggest fears is,
it really does come up all the time. And so then the question becomes, how do I defend against that, right? How do I prevent that from happening? Everyone is baffled by this, right? Because they have reshaped the landscape, right? And this creates a huge opportunity for them to monetize, right? Reduce their risk, get back to what they love of working with clients, and enhance the efficiencies. And we're going to get surprised by some new consolidation. I assure you of that. You and I hear rumors all the time, and rumors are what they are. But
let's move on to number 3. I think this is my favorite trend of 2025. We've talked about in multiple podcasts,
forcibly, candidly, because they were against the RIA space, but forcibly and aggressively were bashing and denigrating the RIA space, while they were in those legacy roles. Then they retire from those roles, and now they're starting firms to try to pull advisors out. It's clearly the trend.
I also just think it's kind of a lesson. If you're still at a captive employee firm.
I think, there's some information that I think is kind of jaded, and some of the information I think is intentionally jaded.
Hey everyone, this is Corey Whalen, managing partner of Bridgemark Strategies. I really appreciate you joining the podcast today. 2024, to say the least, has been an extremely eventful year. We just wanted to give you a quick overview of some of the observations that we've been seeing from people that are neck deep in the recruiting world, day in and day out, as well as what some of our future views are for 2025. Today, Jeff Nash, the CEO of Bridgemark Strategies, is also on the call to share his insight. Jeff, always a pleasure. I really appreciate you hopping on today.
Absolutely, my pleasure, Corey. Thanks a lot. Thanks for having me. Thanks for doing this as well. You provide great insights for a lot of listeners out there, so it's great stuff.
I appreciate it, and always appreciate you spending the time to come on. Jeff, we've seen a ton of things this year happen. Quite frankly, just too many to be on an hour-long podcast form on this podcast today. But one of the first things that I've noticed that I've seen in 2024, just a record amount of consolidation amongst the independent broker-dealers out there. I mean, just to give people an idea of just some of the things that have gone on this year, Cetera purchased Avantax. Cetera purchased another organization, Pro Equities. LPL has won quite a few large, mid-sized independent broker-dealers over the last couple years, but still continues to grow with Atria, the Investment Center. Lincoln recently just sold to Osaic. B. Riley's independent channel recently just sold to Stifel as well. It's really interesting what's going on in the industry. If you just rewind over the last couple years, I just took a look at 2018 top independent broker dealers by revenue and compared it to the top 30 broker dealers by revenue today. And just in 6 years' time, 17 out of those 30 firms have changed owners, which is just an unbelievable amount of change. I mean, Jeff, what do you see going on in the marketplace from your seat?
It is clearly consolidation, right? So that just states what you just stated, the consolidation being the trend, but it's why, right? Why is the consolidation and will the consolidation continue? And the drive for scale, the drive for profitability and larger firms, and also the aging of the entire industry, right? So if we look at what's underneath these firms, it's an older advisor base. And the larger firms are bringing in younger advisors at a faster rate than some of these legacy smaller, boutiquier firms. And so you've got an ability to acquire firms, consolidate, drive efficiencies, drive profitability, and also lower your overall advisor base again with that consolidation. So it's bringing more youth in. There's more training programs. There's more developmental programs. And that trend is going to certainly continue. Everyone asks me all the time, where are we in this process? And I still think we're in the third inning of this as if we're in a nine-inning baseball game. Maybe we've pushed a little bit into the fourth inning here. But we're not anywhere near what I would describe as the seventh inning stretch, right? We're not anywhere near this thing maturing. There's going to be another 5 years minimum, probably 10 years of this. We've seen over the last I think over the last 2 years alone, we've seen the same number continue to be printed, which is upwards of a third of advisors, 10,000 advisors a year could be retiring. And that number hasn't changed over the last 2 years. So there's certainly a lot of consolidation that's going to continue to happen in this industry. And I think the important things for people is, okay, well, while this is happening, what happens to me, right? What does it mean to me? What do I do with this information? Where do I go? What are my choices? What are the implications to me? And, I'm excited to talk to you about some of that stuff with you today as well.
Yeah, and just another thing that I've observed, Jeff, these are no longer, small sub 1,000 financial advisor independent broker dealers that are getting acquired. These are, 2,000, 3,000 person independent broker dealers with, a ton of revenue. Basically firms that maybe in the past, the financial advisor may have thought that they were safe and are kind of had the size and scale inside of their independent broker dealer, to not get acquired. I mean, 4 of the 5 people that I mentioned on that list are sub 2,000 plus advisor, firms that are getting acquired. So I think that's really interesting to see.
Yeah, no question. I mean, and we could even add there's even some non-acquisition acquisitions in there. So I just was reading in the news just the other day, Prudential, which is shutting down their broker dealer and for all intents and purposes folding into LPL, is started that transition process now. And that's not even a traditional acquisition. Prudential is going to stand alone as an entity, but they actually don't have a broker dealer. So they're going to be kind of a group of advisors under an entity under LPL's broker dealer. But again, further consolidation in the industry, and that's over 1,000 advisors, 1,500 advisors. So it's just another example of the consolidation. And you've got firms like LPL that are, they're just providing, more economic resources, and other firms are having a difficult time competing, right? And so, the old expression, if you can't beat them, join them. And I think that's what a lot of what's happening with these firms.
Yeah, I mean, I speak with a lot of financial advisors, obviously, that are considering making a move to another firm, and one of their biggest fears, especially if they're trying to go, to a firm where they're not just a rep number, one of their biggest fears is making a move to an organization, going through the 6 months of headache that it is to actually make a transition. And then a year down the road, they wind up getting sucked into the gravitational force of a larger RI broker dealer that they maybe don't want to be at.
It really does come up all the time. And so then the question becomes, how do I defend against that, right? How do I prevent that from happening, of actually having to switch twice, right? I just switched firms and now my firm was sold and I never thought it was going to be sold. And I can't do this to my clients again in another 6 or 12 months with the firm selling. And there's certainly questions you can ask and things you can look for, but a lot of that comes back to just some basic questions. What's the succession plan of the ownership structure? Can you negotiate if you are switching firms? Can you negotiate in your deal, some flexibility around, hey, if there's a change in control? So there's things that advisors can ask. There's a lot of questions that we help advisors ask to really try to understand, okay, what are the growth rates for the firm? What's the strategy? What's the exit strategy? And for firms that don't have an exit strategy that's really clearly laid out, there's really some risk in there because, they get offered a big number and that number's, and the numbers are getting bigger and bigger. And everyone always says, hey, it just takes a big enough number for me to change what my historical thinking has been. And that's true from the executive leadership of a lot of these independent broker dealers. And that's exactly what's happening. I know a lot of individual stories on firms that have sold that were not even really up for sale. And the numbers were being offered were just so large, they couldn't say no. And that's how that happens. So it really is coming down to making sure that some of the leadership of the firm has a strategy. If you're concerned about that, being sold while you've just made a transition.
Yeah, and if anyone is interested, we have a PDF that we've built just through our years of experience helping financial advisors navigate a transition and taking a look at some of these firms, to just help to ask the right questions to differentiate some of these independent broker dealers. And a big part of the section is actually the ownership, just to be able to vet out, which firms are more likely to potentially sell than others as well. So we definitely have a PDF there that will be really helpful to you.
Hey, Corey, that is such a great idea, right? I mean, we've definitely created some resources, and that's a lot of what we do every day of trying to help advisors, think ahead and not just make a decision based on the likability of a recruiter or the likability of a firm that they're talking to. And, we hear it all the time, hey, I really like these people, and that likability sometimes makes it hard to say no to them. Even when in your heart it's not the right firm for you, just because you really like the people and they've spent a lot of time with you, and so a lot of it comes down to, making sure you're doing your due diligence and asking the right questions to get the right answers that will become the right solution for you. And that's some of the PDFs that we've created.
The second thing that we are seeing a ton in the industry right now, especially observations that I've been seeing, is just a huge amount of consolidation in the RIA space. Every time you open up a trade publication, whether it's Advisor Hub, whether it's Financial Advisor IQ, Investment News, there are huge headlines of 300, 400, $500 million teams, multi-billion dollar teams selling their independent practice or their RIA and rolling up into larger strategic acquirers. I just read the other day in a Cerulli survey, these roll-ups or strategic acquirers, they're growing at over 31% year over year and account for 1.5 trillion in assets under management, or in other words, 18% of the RIA channels total assets under management, which I think is really, really incredible. This mergers and acquisitions in the RIA space, it seemed like it only started about 5 years ago when it truly started building momentum. And just to give a little bit of comparison around those AUM numbers, basically in 5 years, these strategic acquirers have built a cumulative firm, basically the size of a Raymond James or an LPL Financial, which I just find extremely, extremely impressive. Jeff, what are your thoughts about what's been going on in the RIA space?
It is, everyone is baffled by this, right? Because they have reshaped the landscape. We used to see the value of a financial advisor's business at 3 times revenue, and now we've seen deals at 5 and 6 and more times revenue, right? Literally 6 times revenue. And of course, these are all, multiples on EBITDA, but when you just back into, and we've talked about EBITDA versus revenue, but when you back into the math, these multiples have just exploded, and these firms are growing. And they're not just growing on acquisition growth, right? That 31% isn't just on market growth. It isn't just on acquisition growth. It's on actual client organic growth as well, with just new client accounts. And that's what a lot of what's driving their success. So this, again, to me, is really in the early stages of the environment, right? With all of the consolidation that you just cited, the one thing that really sticks out to me is net new RIAs every year. So we're seeing this massive consolidation. Every day you pick up a trade journal, a news article, and you see another consolidator acquiring another multi-billion dollar or multi-hundred million dollar, independent advisor or hybrid practice or RIA. And yet each year, new RIAs are starting more than those that are consolidating.
Yeah.
And so this trend isn't going away anytime near term. And the opportunities are for advisors to really understand this space and what could happen to them, right? What I see in the space is these firms, in many cases, aren't just paying more money for what an advisor's practice is worth, right? Which they're providing a platform for the G2 advisors, right? The next generation advisors to continue to make a lot of money, to have equity in the company. They're providing a platform to actually have better service for the clients, right? Better tools, better resources for the clients. So they're really thinking about this from an end-to-end perspective. And that's really a lot of the reason why I think they've got this momentum and it's continuing.
I mean, yeah, Jeff, just another thing that I said, you briefly mentioned it when you were just talking, but more and more I speak with financial advisors, either on the independent channel or the RIA channel, that are kind of a curse of their own success. You know, they grow to 400, 500 million, $1 billion in assets under management. And a financial advisor that just once really loved what they were doing, which was going out and building their business and talking to clients. Now they're a CEO of a company. They're doing performance reviews with all their financial advisors and their staff. They're a portfolio manager. They are a financial planner. They are a marketer. They're all of these different things and wearing all of these different hats. And one thing I
Forget.
think a lot of these roll-up RIAs have perfected, have just been being able to take some of those hats and outsourcing them for a financial advisor so they could just get back to what they're really good at, which is building their business, prospecting, and servicing their current clients in a more efficient way.
Yeah, I was going to say, don't forget they're a CEO, right? And a lot of them aspire and really enjoy that role, and that's great. But a lot of them realize they would prefer to be an advisor, right? Just love working with clients and doing the financial planning and really helping clients, and some mentoring as well is a nice part of that because they like mentoring what could be the G2 inside the firm. But the CEO is a whole different level of time commitment and stress. And, so what you said is exactly on point. And it's all what happens with advisors is when they create these organizations, more and more of their day is less and less things they enjoy doing. And meanwhile, they've got more and more risk, right? Because they now have this 100% or the overwhelming majority of this company. So they've got more risk. They've got more of their total net worth tied up in this company, right? And this creates a huge opportunity for them to monetize, right? Reduce their risk, get back to what they love of working with clients, right? And enhance the efficiencies. And I said it earlier, right? A lot of these firms are actually providing greater services to the clients. So when it really becomes focused on making sure the clients are taken care of, that box is not just checked, but it's a check plus because it could actually be better services when we look at, integrating tax and estate planning into one consolidated firm, right? Where I know a lot of advisors have a tax specialist or an estate specialist that they work with their clients, but those are still different firms, right? They're different companies. It's not one integrated solution, and so that's what we're seeing in the marketplace. And I think that's going to continue to drive a lot of this consolidation.
And I mean, I think I know your answer to this, Jeff, but do you think that this is here to stay?
Yeah, certainly for near term. I mean, near term being a minimum 5 to 10 years, it's not going anywhere. There's too much opportunity here, really is how I see that. What is changing though, right, is there's a few things that are changing in the marketplace. One is not all firms are created equal, right? Not all strategic buyers are created equal. So there's a lot of research that still needs to happen. There's a lot of firms that are espousing future growth, but don't really have the pathway of future growth. So that has to be evaluated when you're looking at who the strategic buyer is, right? To trade just to trade again, right? Hey, we're going to buy you and then we're going to sell and then we're going to get a higher multiple and everybody's going to make a lot of money. There's a lot of firms out there professing that and selling that, but they don't have a clear pathway as to how they're going to generate more revenue and how they're going to trade at a higher price on the next transaction. So there are things like that that need to be looked at. The other thing that just at an individual advisor level that should be looked at is these massive multiples, right? So we said it on this podcast here, where it used to be 3 times revenue, and now we're seeing 5 and 6 times revenue. That to me is more of a function of what's being bought and when it's being bought versus the actual price, right? For an advisor who's looking to sell his business and retire in the next 1 to 2 years, that's what the old price was of 3 times revenue. And realistically, that's today's price isn't far from that, right? Depending on the size of the business and the quality of the revenue and things like that, that 3 times revenue number may still be actually about the same, maybe a little higher, maybe a little lower, but it's about the same. The businesses that are selling at 5 and 6 times revenue are those businesses that have a track record for growth, have a team that is built for future growth, and can then join a larger firm and supercharge that growth together. And that's the multiples they're getting it's really based on that future growth prospect. So those are the two big kind of eye-opening, lessons, I think, for advisors is certainly not all buyers, not all strategic buyers are created equal, and not all sellers are also created equal, where you're not all going to get the same price.
Yeah, I think that's really good input. I mean, I know me and you, Jeff, have both had, real life examples of this where for reasons out of a financial advisor's control, whether there being sickness in their family or, then themselves kind of had to make a quick exit. And, because of that and not having a plan B to be able to run the company, they're much more in the 2 to 3 times trailing 12 revenue space, even at a really large asset under management or EBITDA number, um, because they just have such a quick timeline that they need to get out of the business. So, I mean, we've both seen that working with clients.
Yeah, no question. I mean, again, for maybe a future podcast, we can get more in the details on some of these things, but just the real simple math is when a buyer buys a firm, right? They're typically buying it on what we call free cash flow or EBITDA. And that free cash flow or EBITDA is then a multiple. And part of that multiple is actually tied back to the future growth after the transaction. And so the headline numbers that people see in 5 and 6 times revenue, there's some percentage of that is actually tied to future growth. Now, the right firms that have the G2 in place and the motivated sellers to continue to work hard will almost always achieve those growth numbers because they're not unrealistic growth numbers. It could literally be 10%, including market appreciation. So they're not unrealistic growth numbers to be able to achieve, but somebody has to work there to get those growth numbers. And that's when you get those big headline numbers of 5 and 6 times revenue. Minus that, right? Minus those growth numbers, then you're back to the 3 times revenue in many cases. And that's really what the value of the book is, that we see in the marketplace, and buyers are becoming more attuned to this also, right? Again, I think there's an element where, in the real early stages, it was just buy to for buy's sake. But the buyers themselves have gotten more sophisticated. The private equity firms have absolutely influenced buyer behavior, where there were buyers out there who were just willing to overpay, knowing that they could get a return on that investment. Well, private equity firms aren't just looking for a return on investment. The private equity firms are looking for an ROI, right, that is in the 20+% range. They want to double their money in a year. They want to triple their money in 2 years. So it's not just having some return, it's having the right returns. And so they really are looking at the right firms to acquire.
Yeah, for sure. Definitely more selective for sure. At the same time, I get asked the question all the time. Do you ever think, the smart money or the institutional money is going to go away, in terms of backing some of these larger RIAs in the RIA space? And I mean, literally just a couple weeks ago, Dynasty Financial Partners got a $800 million valuation, and private equity has been moving into the space in droves, but it hasn't been necessarily some of the larger ones. But just with Dynasty's $800 million valuation, JP Morgan Asset Management, BlackRock, and Charles Schwab all took some sort of stake in Dynasty as well. So even the biggest of the big in the organization are starting to invest in this space, which is just another case to say that this money is here to stay.
Yeah, honestly, we could go and look at the history of private equity, even just in our industry, right? To me, private equity will stay in as long as the growth potential stays in. And it was what, 15 years or so ago when robo advisors were the talk and everything robo was going to take out advisors and it was going to take over market share. And private equity was all over all of these different robo investments, right? And robo went from 0% market share to today, I think it's around 7% market share. And by the way, we don't hear anything about private equity anymore because it's been flatlined, from 7% market share for probably the last 7, 8 years. So the growth rate has died down. And so we don't hear that much about robo. But to go from 0% market share to 7 is a huge, tremendous upside swing. That's the growth. And that's what the private equity is looking for, is that market share, right, expansion to be able to capture that growth. that's where we still have huge market share, right? When you talk about 18% in that RIA acquisition space, right? 18% is still a long way to go from 70%. And 18% is from zero. And there's 300,000 financial advisors with as many as 10,000 retiring a year, right? So there's still enormous growth potential. And that really, to me, is the leading indicator of when private equity will start to say, well, look, when this starts to mature, that's when you're going to start to see the private equity, I think, kind of pulling back. And the multiples may pull back as well. That goes with that, which is true of any investment. When the growth rate slows, right, price can drop.
I thought another really interesting thing, Jeff, we were talking about this the other day, but some of these US private equity firms even expanding over our northern border to Canada. I mean,
Yeah.
just a couple news articles that have come out recently. Focus Financial just absorbed a couple different firms, Cardinal Point Advisors in Calgary, Gavin Wealth, hockey specialist in Toronto, and even Merchant has invested in a few firms, a firm called SPM Financial in Ontario. So the demand is even going over the border.
Look, the financial services industry, I don't know as much about it in Canada, but I've got to assume it's the same, right? I mean, we can look outside of financial services. I mean, we could look at the CPA industry. There's a lot of industries that have the average age of their key folks, right? CPAs or financial advisors is in the 50s and above, and there aren't enough youth coming into these positions. And so there's a consolidation opportunity, right? And that's what we're seeing. And we see that again, even in the CPA space, we're starting to see private equity in acquiring CPA firms, which used to be sold at one times revenue, and that's starting to trick up here a little bit. And more private equity is coming into that space as well. Private equity has been in the medical space with doctors' offices. They've been in the veterinarian space. We've even seen them in dry cleaners. So when there's opportunity for growth and consolidation and efficiencies, that's where private equity is going to find, their way in. So that it's no surprise, when we look at Canada and we look at the wealth management space up there, that firms that understand the business model in the US, and we'll have to certainly learn about the rules up there because I'm sure some of the rules are different, but largely the business model will be the same, and that's an extension of their skill set.
It's interesting to see what happens in 2025 for sure.
Yeah.
Um,
Yeah, I love thinking about that. What's going to happen? Obviously, we've got new government coming in 25. There's a lot of international things going on there. The markets, of course, everyone's always concerned about the markets, but what's going to happen in the consolidation space? We're going to get surprised by some new consolidation. I assure you of that. You and I hear rumors all the time, and rumors are what they are. But a lot of them never happen. But I'm sure there's going to be something that's going to surprise us in the consolidation space in 25. And we're going to see more new entrants, more new PE firms, more new RIAs starting that are going to be looking to acquire firms, increasing the competitiveness. Those are some of the things that I'm certain we're going to see in 25.
Hey, breaking in real quick. I really hope you're enjoying this episode and finding my YouTube channel of value. If you're a high performing financial advisor that can use somebody as a guide or a resource to explore all your transition options out there in the marketplace, I'm a non-biased, independent transition consultant that can help make this process so much easier for you. And another plus, it costs absolutely nothing to work with me. If you want to have a conversation, please feel free to text, call, email, DM me. My contact information is all over this episode, and I'll let you get back to it. Let's move on to number 3. I think this is my favorite trend of 2025. We've talked about in multiple podcasts how much optionality is coming out for financial advisors in the independent and RIA channel. Jeff, I know we talk about this all the time. Me and you are in the industry every day, studying the industry, speaking with financial advisors, and almost every day a financial advisor asks us, hey, have you taken a look at XYZ firm? And we have no idea who it is, even though we have hundreds of options to help financial advisors explore. There's just new entrepreneurial advisors and leadership popping up that are starting new opportunities for advisors every single day. But one that I've seen a humongous pattern on in 2024 is lifetime wirehouse industry top leaders that have been leaving the wirehouse and starting some sort of independent option for financial advisors as another breakaway solution. And we've seen this quite a bit, and it's really interesting. For the last decade, we've consistently been seeing financial advisors exponentially leaving to go to the independent or the RIA side on a year over year basis. But now, leadership who 10 years ago at the wirehouse would have thought it was crazy for a corner office wirehouse financial advisor to make a move to the independent channel. Some of the top leaders in the industry are leaving to start their own firms. I mean, Jeff, just this year, Jeff Koak, the ex Wells Fargo Advisors CEO, started an RIA called Ampersand Partners that has had immense success, has a really good reputation with Wells Fargo financial advisors, an amazing Rolodex, understands the pain points that they're going through and has solved for that at another model. John Thiel, the ex-head of Merrill Wealth, he just started another firm, Indivisible Partners, this year as well. And then just doing a quick recap over the last 4 years or so, Jim Dixon, an ex-divisional executive at Merrill, started Elevation Point. Vince Fertitta, ex-divisional executive at Merrill, started Sanctuary Wealth. Greg Fleming, the ex-president of Morgan Stanley Wealth, is now the CEO of Rockefeller. Bob McCann, the ex-US head of wealth at UBS, now running up New Edge. I mean, this seems to be a really significant pattern. I mean, Jeff, what are your thoughts on the process and the success of this going forward?
I find it amazing that these are folks that have, really, in their roles, forcibly, candidly, because they were against the RIA space, but forcibly and aggressively were bashing and denigrating the RIA space, while they were in those legacy roles. Then they retire from those roles, and now they're starting firms to try to pull advisors out, that they had known, tapping into those relationships and building their own firm for their own, next gen of wealth, et cetera. It's clearly the trend. The RIA space is not the Wild West that I think a lot of these folks have said it was. It's not a place where low producers go, which is what a lot of folks used to think of it, right? We used to see the average production. I mean, this is 15 years ago. The average production in the RIA space was one of the lowest in the industry, and that's just not the case anymore. So it's not paving new roads. It really is an established place. And, it's going to be interesting, where these firms are net losing advisors, right? So all those firms that you just listed, if we look at the last 5 years, we look at the last 15 years, year over year, net losing advisors. And they sit there and they talk about how they're growing year over year because they have, new assets, which of course, as markets are going up and they've got new clients, right? So their growth is driven from organic growth of new, the advisors inside the firm growing the business and the stock market growing, but they're losing advisors. And they're not losing the lower end advisors. These firms are losing the higher end advisors. They're losing the multi-billion dollar teams. And those are the ones that are breaking away, and so there's a real clear trend to me. Again, this goes back to our earlier conversation, which is why private equity is in this space so heavily. But there's a real clear trend. And, and for those folks in the market, my only advice I can really give is I wouldn't necessarily join any of those firms that you just said because you know the people, right? It's to me, when it comes to joining a firm, you really want to make sure you're joining the firm that's going to be the best for yourself, your business, your clients, right? And it's not necessarily because you know those folks, so it really becomes a function of knowing them as a part of the decision-making process, and it becomes added into the mix, but it's not necessarily a decision of, you don't just join them for that reason.
I totally agree. I also just think it's kind of a lesson, if you're still at a captive employee firm, take what your leadership says about, absolute truths in the industry or what life is like on other platforms in the industry with a grain of salt. I think very much that sometimes they have the best intentions in place, but just keep in mind that they have a very vested interest in keeping you in your seat. Their comp is very much tied to you staying in your seat. And sometimes the advice and things that you get are very, very biased. And just having a conversation with somebody like us, you have the ability to truly understand what the other side looks like, weigh the pros and cons of some of the other options out there in the industry, connect you with other financial advisors from your firm that have actually made the leap, get an understanding of where they went and what they gained by making the transition so you can make a smart decision on what works for you, not just the viewpoint of leadership of an organization.
The one thing I would say on that topic, it's something that I hear it a lot, and I hear advisors, I even hear leadership from some of these firms when they talk about the succession side of the business, and they're educating advisors, and it's from a place of their attempt to educate, where they say, "Hey, your business is worth X." And that X is often a 2 or 3 times revenue. Your business is worth X. We're going to give you top dollar for your business when you're ready to retire by staying here. And they're educating advisors by telling them your business is worth X. And the reality is that business is worth so much more than X. In fact, it could be 2 or 3 times more than what they're saying. And they're just literally making numbers up that aren't real. And I hear it from the advisors that said, "Hey, I've been told my business is worth this." And I was like, "Well, let's look at it." And we kind of peel back the layers, and literally 3 times the amount of money when we factor in taxes and the entire, what could be a deal structure, is what they could be getting that much more. And so it's really about, I think, there's some information that I think is kind of jaded, and some of the information I think is intentionally jaded. I think some of the information is unintentionally jaded, because they're just not necessarily sure exactly what businesses may be worth, outside on the real marketplace. But you really have to look at that information, and to me, the most glaring one is around succession. When I see some of these sunset programs, and I see some of these, internal valuation deals and internal valuation structures that are not even remotely close to where the marketplace is.
Agreed. Agreed. There is, so much misconceptions and head trash out there. I think it's so important to put the right inputs into your should I stay or should I go, decision matrix. And if you're not speaking with, somebody that's truly independent in this process, some of those inputs might be really, really off in your equation. It's not our job to help you, to convince you to make a move to another firm. It's just simply to give you the right information that you need to make an empowered and confident decision that to either stay or go.
It's a great point, though, what you just said. It really isn't our job. Our job is to provide you information, right? And that with that information, because knowledge is power, and our differentiation and our success is really about educating advisors, and then they realize there is a better place. The grass can actually be greener.
Well, Jeff, I really appreciate your time as always. If anybody has any questions about it's a high level overview of the marketplace or another channel or firm that they're curious about, we're glad to have a conversation. We work with over 125 firms out there in the marketplace and can truly just be unbiased and can make this decision making process so much easier and streamlined for you. I really hope you enjoyed the podcast today, and I hope you have a great day.
Thanks, everyone.